Chervo. In a move widely predicted, the Reserve Bank has kept interest rates on hold, but it still delivered a sickening blow to borrowers. The central bank warns inflation will remain high until the end of next year, meaning hefty mortgage repayments will continue to hit family budgets for at least the next 18 months. That comes as property values fall and are expected to keep falling. For more, we're joined by Paul Bloxham, Chief Economist at HSBC. Morning to you.
Good morning.
No one was really shocked. This was expected.
That's right. So the market was fully priced for the idea that the RBA would stay on hold, and it was the consensus amongst all the economists, including myself. We thought that they'd be on hold as well. So on the day, that wasn't a surprise. What was most interesting out of what came out of yesterday was the RBA talking about the idea that the economy is weakening, and it actually needs to weaken and continue to remain weak. Otherwise, inflation might still be a challenge, and they may still have to come back and lift interest rates further. So I think the main message was, don't think that necessarily you're going to get rate cuts anytime soon. It's possible they're back here at some point lifting rates. Now, we don't think they'll have to. We think the housing market's cooling fast enough that will actually weaken the economy enough that they won't have to lift rates. But I don't think anyone should expect interest rate cuts anytime soon. So
is the housing market cooling faster than everyone thought?
They're certainly cooling faster than the RBA had been expecting. And a part of that story is that we've seen these big changes to the tax system that came through in the May budget, and that's been subsequent to the last time the RBA put forecasts together. So it is cooling faster than they had thought.
Well, because that's interesting, because when you talk to the government, they sort of say, oh, well, it's not us, it's other conditions. That's why the housing market's falling.
I think it's a combination of factors. I think it's the fact that the RBA has lifted interest rates 3 times this year, and the fact that there have been substantial changes to the tax system, particularly related to housing investment.
So when we look at the housing market, it's obviously, a lot of little markets, isn't it? It's not one big market. They're under 1.5 million market, so the first home buyer market. In a lot of areas, that's not actually falling, it's just growing slower. What do we think is going to happen there, or is it too hard to predict?
Look, I think that there are 2 big forces weakening the housing market. 1, interest rates have gone up and they're above neutral, so they're a bit more elevated. And 2, there have been big changes to the incentives for investors to get involved. I think those are 2 big forces that are pushing the national housing market down. We're seeing all of the capital cities are cooling, and we're seeing all of the regions are seeing declines. And it makes sense because it's big changes to the overall system that are weakening them. I think the housing market, I think this is just the beginning of a housing market correction. We've still got much more of this to run yet. We've only seen house prices fall a bit. We think they'll fall still for a number of quarters, and we're looking at sort of house prices falling by up to 8% over the cycle.
Are we talking years? How long?
Well, certainly, I think running into next year is what we've got in mind, that house prices will fall for the rest of this year and running into next year as well. And that's largely because, again, we don't think the RBA is going to be able to consider cutting interest rates for quite some time, until well into next year. Okay. So it's normally an interest rate cut that is the thing that really starts to motivate the housing market to turn. And if you don't get an interest rate cut for quite some time, then housing prices are likely to continue to decline.
OK. Thank you very much, Paul.